Okay, go.
Hi everybody, Professor Jim here. We're looking at Accounting 2, Managerial Accounting. If you're in my class, we're in Chapter 19. We're going to focus on the paper here with the information and not on how I look during COVID-19. I look fine. I don't have any problems with anything. But we're going to focus on this. Okay. All's good with the other thing. With me, anyway. Hopefully with you too. Okay, anyway, dollars are going to be in US dollars. That's in case any of my friends from Canada, Mexico, France, Italy, UK, etc., Japan are watching this about accounting. So it's all in US dollars. All right, we're looking at variable costing and analysis. So we're going to focus on things that are variable costs. There's also fixed costs. They're one or the other. Okay. So in this chapter, they talk about income reporting. Now, regular income reporting, generally accepted accounting principles, basically worldwide. Absorption costing is generally accepted, and variable costing is not. So the question comes up, why are we looking at variable costing as like cost of goods sold or on the income statement? The reason we're looking at variable costing is what happened a whole bunch of years ago is companies would turn down projects where they couldn't cover all the fixed costs, and then they'd lose out on projects. And some of these companies eventually went out of business, and some did not, but they only took the projects that covered everything. So somebody came along and said, hey, we don't have to cover all of our costs with every project. There's usually multiple projects going on per company. It could be dozens, even hundreds or thousands of different projects going on at the same time, depending on the company, how big it is, and how much they have going on. So as long as it covered variable costs and part of fixed costs, it adds up to cover all the fixed costs and make some profit, and it's all good. That's why they came up with variable costing. That's kind of hidden in the chapter. Okay, towards the end, but it's there. Okay, so what are we looking at? Income reporting, planning. Okay, planning's big with managerial accounting, of course, controlling costs, any kind of accounting, right? And CVP analysis, that's the, cost, volume, profit. Okay, we'll call it also known as break-even analysis. We've gone over that already. Right, fixed costs over price minus variable cost per unit. Okay, flip chart on to page 2. Okay, as mentioned, what we have is general accepted accounting principles. That's what we would use for balance sheet, income statement, etc. Okay, so when we look at this thing, we're going to look at variable and fixed overhead, and they're included in product costs for the absorption costing. Okay, so they include everything, right? All together. Variable costing, they look at the overhead and the direct materials and the direct labor, and those are all counted as product costs, and the fixed overhead is counted as period costs. Period costs take place during a certain period of time. Hence period costs. Okay, that's the main difference between reporting. As mentioned in the chapter, they're going to show reporting for variable costing as an example. Okay, all right, these are the numbers right from the book. Direct materials, same for each, right? Whether, it's absorption with everything. Think of absorption costing like a giant sponge that's full of water. It has everything in it, all the water. And variable costing has some of the water. Okay, so direct materials, yeah, same thing, right? Direct labor, same thing. Overhead, it's variable, so variables in both, right? So that's the same thing. And then absorption has fixed costs, in our example, of $10. They took $600,000 in overhead. That was fixed. They divided it by 60,000 units. When you divide it, you get $10 per unit. So that's $10. So the total for per product per unit, absorption costing $25, variable costing $15. Right? Variable is always going to be lower because it's not including the fixed part of overhead. Okay, let's try that again. Okay, there we go. Here's our quick mathematical calculation. This is accounting. No calculus needed, no statistics needed for this class. Okay, add, subtract, multiply, divide. Here we divide. Okay, it's all good. Okay, selling and administrative expenses. I just shortened it up, called it S&A. Actually, you can call it selling general administrative expenses, depending on the company. So they're also, they have variable parts to that too. So in this example, it's $2 in expenses that's variable, and the fixed part of it is $200,000 per year. So overall, when we're looking at fixed overhead for this example, these examples, $600,000 a year, and for selling and administrative expenses, we're looking at fixed of $200,000. So we're looking at fixed of $800,000 altogether for these examples. Okay, there's three scenarios. Scenario one, I called it scene one. Sounds like a movie. Okay, anyway, they're going to produce 60,000 units, and they're going to sell 60,000 units. Nice and easy, right? You make stuff, you sell stuff, it's all good. Okay, IS stands for income statement. Separated it between abs and variable. Sales are exactly the same, 60,000 units. They picked $40 each to sell each unit. So, you know, those numbers are the same, right? Cost of goods sold, if you go back couple pieces of paper there, we had $25 for absorption, and we had $15 for variable. So we're sticking with our 25, 60,000 units times 25 is $1,500,000. You take the sales minus cost of goods sold, we get gross margin, right? And then we have selling administrative expenses. There's the fixed part, right? And then there's the variable part. Variable part, you take how many you have, how many units, 60,000 times 2, you get 120,000. You add that to the 200,000 that's fixed, you get 320,000. You subtract that from gross margin, and we get net income, right? And it's 580,000. And amazingly, not really amazingly, variable cost gets the same bottom line number for net income, because you produce 60,000 units, you sell 60,000 units. Shows it a little bit differently here. Variable up on top. You know, sales, of course, same. Variable part all up on top. Fixed part on the bottom. When you subtract sales minus variable, just like in break even, you get contribution margin, which we have here. 800,000 as mentioned before, 600,000 is overhead, 200,000 is the fixed selling and administrative expenses. Subtract those out. Bottom line, it's all the same. Okay, that's great. That's nice. You make 60,000, you sell 60,000. Perfect. You don't have to store any inventory. Okay, scene two. What happens? Well, they're still producing 60,000 units. You can call the first scene 2017, year. Let's call this year 2018 for scene two. All right, what happens? They make 60,000.
Low battery. It's not photographing. Oh, I'm sorry. I should have